Everyone agrees gold is safe. That's the problem. Right now, millions of people are rushing into gold because they're scared of what comes next. Inflation, war, debt, currency collapse. And historically, that exact moment is when gold becomes most dangerous to buy. Not because it crashes overnight, but because it quietly stops working. $4,450. That's the price of 1 ounce of gold right now. Not a house, not a car, an ounce. Gold is at an all-time high again. And for the first time in years, the people buying it the fastest are the ones most likely to regret it. That's the uncomfortable truth nobody likes to open with. Because gold feels safe. It feels ancient. It feels like the opposite of risk. And that feeling is exactly why this moment matters. Right now, central banks are hoarding gold. Retail investors are panicking into it. Headlines are calling it the ultimate hedge. And social media is quietly suggesting this is just the beginning. But markets don't move on feelings. They move on math. And the math behind gold at these levels is far less comforting than the story being told. Let's slow this down and talk through what's actually happening. Not the hype, not the fear, the mechanism. Gold didn't wake up one morning and decide to be worth $4,450. This surge has been years in the making. After 2020, governments printed aggressively, inflation spiked, trust in fiat currencies cracked. Then geopolitics stepped in. Wars, sanctions, trade fractures, frozen reserves. That's when central banks changed behavior. For over a decade, they were net sellers of gold. Then they flipped. In the last few years, central banks bought more than 1,000 tons annually. Countries like China, India, Turkey, Poland, Russia. Not because gold is productive, but because it's politically neutral. Gold doesn't default. It doesn't get sanctioned. It doesn't answer to interest rates. At least not directly. So demand rose, prices followed, momentum kicked in, ETFs soaked up billions. Retail investors saw the chart and felt something familiar. Fear of missing out dressed up as prudence. By early 2026, gold was trading between $4,450 and $4,500, setting records almost weekly. And this is where the story usually stops. But this is where it gets interesting. Because gold is not an investment in growth. It doesn't generate cash, it doesn't compound, it doesn't innovate. Gold is a bet on instability continuing. That's the hidden agreement every gold buyer signs, whether they realize it or not. You're betting that fear stays high, that real interest rates stay low, that confidence doesn't return. And history has a very inconvenient habit of punishing those bets at the worst possible time. Look back. In 1980, gold peaked during an inflation crisis. Then inflation cooled, rates rose, gold fell over 40% and went nowhere for decades. In 2011, gold surged on Eurozone panic and post-crisis fear. Then growth returned, stocks rallied, gold quietly lost nearly half its value over the next 4 years. The pattern isn't subtle. Gold thrives on chaos. It bleeds instability. Which brings us to the part nobody likes to discuss while prices are screaming higher. Opportunity cost. When you buy gold, you are locking capital into something that does nothing unless things get worse. Meanwhile, equities earn, bonds yield, businesses adapt. At $4,450 an ounce, gold isn't expensive insurance. It's expensive protection against a very specific future. And if that future doesn't arrive on schedule, the downside isn't theoretical. Even modest normalization, slower inflation, fewer geopolitical shocks, a slightly more hawkish Federal Reserve can trigger 20 to 30% drawdowns. Not crashes, corrections. The kind that quietly erase years of gains for late buyers. This is where the irony kicks in. The same central banks driving demand are not buying at these prices for returns. They're buying for reserves, for balance sheets, for politics. They don't care if gold underperforms stocks for a decade. Retail investors do. And yet, retail money tends to arrive last, right when the narrative feels safest. There's a strange psychology at work here. When assets are cheap, they feel risky. When assets are expensive, they feel validated. Gold right now feels validated. It's everywhere, it's logical, it's justified. That's exactly why caution matters more than conviction. This doesn't mean gold is useless. Far from it. Gold does what it's always done. It hedges tail risk. It cushions currency shocks. It survives regime changes. But it was never meant to be the engine of wealth creation. That's why most serious portfolio strategies cap gold exposure around 5 to 10%. Not 0, not 50. Enough to protect, not enough to dominate. And yet, in moments like this, people don't add gold, they rotate into it. They trade productive assets for something static. They trade future growth for present comfort. Quietly, rationally, convincingly, until the environment shifts. And environments always shift. The most dangerous thing about gold at record highs isn't volatility, it's complacency. The belief that this time is different because the world feels broken. The world always feels broken near peaks. That's not cynicism, that's history. So zoom out. Imagine inflation eases but doesn't vanish. Rates stay elevated but not crushing. Geopolitics simmer instead of explode. Not perfect, just stable enough. In that world, gold doesn't collapse. It simply underperforms, year after year, silently. And that's the outcome nobody plans for. Because it doesn't feel dramatic, it feels reasonable. Gold doesn't betray you in those scenarios. It just waits while everything else moves ahead. So here's the real question. At $4,450 an ounce, are you buying protection or are you buying the memory of fear? Because one of those makes sense, and the other usually shows up right before the cycle turns. Gold will still be here in 10 years. The price you pay today will matter far more than the metal itself. And the market doesn't care how safe an asset feels, only whether you arrived early or right on time. If this helped you see the gold story more clearly, tap like so the algorithm knows this conversation matters. Subscribe if you want calm, no-hype breakdowns of money, markets, and risk. Share this with someone who thinks gold can't go wrong. And tell me in the comments, are you holding gold right now or staying on the sidelines? That answer might say more about the future than the price chart does.